from Walmart and Target signal something ominous is on the way for the economy? Our next guest says the answer is yes and is updating her playbook as a result of that. Erin Browne, PIMCO's multi-asset strategies portfolio manager, with us now. It's good to see you again. Welcome back. I mean, these reports to you, in some respect, was a game changer, no?
It was. I mean, we're really starting to see a retrenchment of all the durable good purchases that consumers bought during the pandemic, post-pandemic period. So while people were at home, they were, buying more retail goods, they were buying more appliances, more TVs. And now what we've actually heard over the last couple of days from Walmart, Target, and some of the other retailers that have announced is that they now have excess inventory in many of these products. And so they're having to expand warehouse capabilities in order to really absorb some of this excess inventory that's now not selling through. We've seen inventory to sales ratios go up, particularly for apparel and for TVs and appliances. And I think there's really more pressure to come, not just for the retailers, but also for the entire supply chain, for the truckers, for the shippers, for everyone down that supply chain that's linked to the, those post-pandemic boom.
Are you telling me I need to stay away from all the truckers, the rails, all the retailers, or can you be a little selective?
I think you can be selective. I mean, I think particularly amongst the rails, some of them are still very much linked to the commodity trade. And so you don't want to be underweight or shorting the rails that are linked to commodities. But those that are, geared towards the more towards goods, I would say away from them, sort of wholesale right now. Where I do think that there's opportunity is you are really starting to see this shift from goods to services accelerate. So I think that there's real opportunity in some of the reopening trades. But amongst the durable good names, I really think the retailers right now are going to continue to remain under pressure. We haven't seen earnings come down yet. And what actually we're seeing is that guidance is still quite robust for the rest of the year, expecting double-digit earnings growth. That's not likely, particularly if we continue to see inventory levels remain high.
But these names that you want me to look for in travel and leisure, they've run already so much. I mean, you have to believe that, there's going to be, say, peak travel at some point, right? Consumers have taken the money they might otherwise have spent elsewhere. They put everything towards the summer vacation they've wanted to take for the last 2 years. They're going to take it come heck or high water, and then they may cut back elsewhere. Isn't all that in the stocks already?
I don't think it is. I mean, pricing has been exceptionally strong. Capacity is still slightly below, particularly in urban areas, slightly below, what they were running at pre-pandemic. And you are seeing people being able to absorb higher prices and higher price points for their travel spend. And so I think that pricing power exists. The other thing that's, I think, really important to keep in mind is you're starting to see labor wages start to roll over. And yes, they're at very high levels, but on the margin, you're starting to see more labor capacity come back into the market. And this has been a significant drag on margins for these service-oriented names over the last year. And so as you start to see that abate a little bit, I think that also is going to add margin strength to these underlying names. And I don't think that right now is being priced in to the market.